Hello, fellow Rebel Capitalists. Hope you're well. I am here at Hugh Hendry's place in fabulous St. Barts. In fact, I'm going to give you a little insider look there. That is Hugh's room. This is the living room, kitchen. Oh, there is the Caribbean. If you didn't have that reflection, you could see St. Kitts and Nevis, an island called Saba, and around the corner you could see St. Martin. And if you could, I don't know if you can see Hugh's pool. Oh yeah, there you can see. He's got kind of this cool setup here where the infinity pool goes right off the edge, and then what you see is the Caribbean. So it's really, really cool. But hey, we got a lot to talk about. Stocks plunging today. We've got recession odds going up. We've got expectations for Fed rate cuts. Bitcoin just tanking. At one point today, I saw it was down, maybe 76? I think currently maybe 78. 10-year Treasury down 10 basis points today. I mean, at the stock market, I don't know if you heard this, but stock market at one point in time today was down 1,100 points. And this is on top of the sell-off we have had, for the last 2 weeks. So it really is kind of playing out with this hypothesis we've had on this channel that maybe, just maybe, the narrative is changing. And we're going from bad news being good news to maybe bad news is bad news. There are no certainties, only probabilities, but boy, oh boy, the market does not like what's going on. In fact, just in the last few weeks. So it's really getting crazy. Like I said, 2025, most likely never going to be a dull moment. That's exactly what we're seeing play out in markets today. So let's do the screen share and get over to the specifics. I want to go over to the CNBC homepage and let's do a refresh here. Yeah, so Dow closed down 890 points. They say the NASDAQ suffers the worst day since 2022 as recession fears erupt. Their words, not mine. And what was really, I thought, quite fascinating is you didn't really have any news that came out today that would suggest, oh my gosh, the house is on fire. In fact, you know what I want to do here, guys? Let's go over to that calendar, that market. I always like going to that Market Watch calendar. Where is it? Here it is. So let's see if maybe I'm just missing something. But I didn't see any big news come out today. So we've got March. Yeah, nothing scheduled. Zero. We could see some big fireworks on Wednesday. That's for sure. With the CPI, jobless claims on Thursday. But yeah, so to see this type of massive move when really we had no news, it really makes me kind of lean toward the whole potential narrative shift. So yeah, this guy, I guess the picture of this guy pretty much sums up what happened. And of course, they blame everything on Trump. I'm not saying he doesn't have anything to do with it, because I think a lot of this has to do with his approach, and I'll let you be the judge as to whether or not you like his approach or his policies. But the bottom line is he comes out just rapid fire with so many things, and he does contradict himself. I mean, even you're the biggest Trump fanboy on the planet Earth, you have to admit that he does contradict himself quite a bit. Now, that could be his strategy. Maybe he's playing 4D chess, but it creates uncertainty the market just doesn't like. But I think the mainstream media goes overboard with just literally blaming everything on Trump. And I don't think that's fair either. Like right here, and especially the way they say it. I mean, they would never say anything about or like this or kind of use this tone with a Joe Biden or a Kamala Harris. Like right here, Trump an agent of chaos and confusion. Like, can you imagine them saying that about Kamala Harris? No chance. No chance. No chance. Even if they did insinuate Kamala Harris's policies might be leading to uncertainty, and that might be why the stock market is coming down, they would never phrase it that way. And I haven't looked at the other headlines, but I'm sure half of them are Trump this and Trump that. Yeah, Trump media falls more than 11% as broader sell-off intensifies. All right, here we go. Well, that's talking about, another thing that I discussed, just kind of off topic. I was talking to Steve today. We were having lunch, and I always enjoy kind of picking his brain and seeing what he's thinking about, the framework he's using, and how he's putting on trades. And we're going to do a webinar on Friday in Rebel Capitalist Pro. So if you want to go over to georgegammon.com/pro and sign up for $1, you can participate in that webinar. And I'm going to go over everything that I've kind of learned and everything that we discussed here in St. Barts, not just with Steve, obviously with Hugh. And there's a couple other fund managers here. I think I just saw him go by. I see his shadow. He's walking around here somewhere. But I won't disclose his real name, but he runs about a $10-15 billion fund. And he's one of Hugh's real good buddies, and I know him extremely well. So it's really interesting to get his take. We were talking about the euro, actually, today, the euro and the dollar today at breakfast. But anyway, if you want to sign up for that, georgegammon.com/pro. So getting back to really the fireworks in the market here, what I found really kind of shocking is the China bond yields jumped to 3-month highs as investors pair rate cut expectations. So now it's like we saw China falling off a cliff, we saw Europe falling off a cliff, and then all of a sudden Germany comes out with stimulus, and everyone's now bullish, which I think is temporary, Germany, because you guys know my thoughts on stimulus. and then now the expectations for China, Japan, Germany, inflation expectations going up, growth in inflation. Maybe they're coming out of this economic contraction, where now it seems like the market is completely turned their back on the United States, and now they're being perceived the same way as maybe Europe and Germany were a couple months ago. Again, you can't judge things just on one day, but it's just like this. We're seeing a trend really start to play out in this in the stock market and with these different asset classes. And on that note, I was talking about the 10-year. So it closed, now it's slightly up, but for the day it was down like 9 or 10 basis points. And just to keep you guys to keep you guys up to speed as to what's going on here with the curve, we had this crazy move in the 10-year when the Fed drops by 100 basis points. The 10-year Treasury, we can look at a chart here, goes up by 10-year basis points. So if you thought the Fed controls the curve, guess again. So the Fed starts cutting here, not hiking, cutting, and the 10-year Treasury just basically gives them the finger and goes straight from 3.6 right up to 4.8. But then more recently, it's come down to the point where the curve inverted again. And the big question last week when it inverted is it going to stay inverted? Is this just a blip? Is this noise? What's going to happen here? And sure enough, it's stayed inverted. And at a certain point, it's even gotten more extreme, which to me is just, again, growth inflation expectations, lower, lower, lower. And it's almost like the curve is kind of trying to signal to the Fed that, hey, guys, your risk is not in inflation. Your risk is with unemployment, and looking at it through the Fed's lens. And you're going to have to start dropping. In fact, I think more importantly, let's look at the 2-year Treasury yield. Oh, wow. Yeah, look at this. So if you weren't watching the videos yesterday or last week, we were down under 4%. But look at this today, down another 10 basis points. This is the 2-year, not the 10-year, the 2-year, down another 10 basis points to under 3.9%. Why is this important? And I would imagine the move has been just as severe as the 10-year. No, it hasn't. So it hasn't been as extreme. It's down, call it 42 basis points, where the 10-year is down about 60. So this is just screaming at the Fed that they are completely offsides. And just to get you guys caught up on what I'm saying here, when we look at that is 10-year, let me look at the right chart here, guys. Bear with me. I want the Fed funds versus the 2-year Treasury. You can see all my tabs, and this is why I've got all the tabs. Huh. I don't think I've got that one. Josh, can you do me a favor? And this might be it. But as you can see, this internet is not great here. Josh, can you do me a favor and pull up the 2-year Fed funds, that Fred chart? 2-year Fed funds, because I want to show the audience how the Fed just follows the 2-year. It's always the 2-year moving first, and then the Fed funds catching up. And it's the opposite too. It's on the other side when they're increasing rates. The 2-year moves first, and then the Fed funds catches up. So now we've got this big delta between the Fed funds, which is at 4.33, and the 2-year, which is now at 3.9. So if history is a teacher, we're going to see those converge, and we've got a very high probability that they converge by the Fed funds going down and not the 2-year Treasury going back up. But let's get back to, while Josh is pulling that up, let's get back to markets, because we have a huge move in Bitcoin. And even if you're not into Bitcoin, or if you don't care about the price, it's still, I think, something you have to factor into your analysis, because it's such a good proxy for risk. And I don't like that. I love Bitcoin, but I don't like that about it. I wish it wasn't so correlated to the NASDAQ and to risk on and whatnot. But it is what it is. That's kind of the way it trades. Hopefully it won't trade like that forever. But to me, and I actually talked to Steve about this today as well, I'm like, do you use like Bitcoin and crypto as kind of a proxy for the risk appetite in the market? He's like, absolutely I do. Absolutely I do. So even if you're not into Bitcoin, I think it's important that you pay attention to the price action, because we can see that, like the NASDAQ, it's, and then we had this bump. It's like, oh, Trump comes out with his tweet, which is one of the things that I really didn't like, because he's just basically rug pulling everybody. But anyway, that aside, we were at 104.
I just pulled up the chart as well.
Okay, great. Let me go over to that real quick, and then we'll come back here. There you go. So Josh, can you, but let's go back. Let's do a 10-year chart, please. And the chart that I usually use goes back even further, but you don't have to do that, Josh. It's because it doesn't matter how far back you go, you would see the exact same dynamic. Like the exact same dynamic, where this blue line, no, I'm sorry, the red line is 2-year Treasury. Yeah, red line 2-year Treasury, blue line Fed funds. And you can see, look at what happens here. Look at this red line, goes down, crosses over the blue line. You get this spread, and then the Fed catches up, right? And then the Fed pauses, and then the red line goes down again, and Fed catches up. And then opposite. This is when we started getting inflation, And remember, the Fed wasn't worried about it. Inflation's transitory, blah, 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 blah. But yet 2-year is basically calling BS. Again, red line starts to go up. That's tough for me to see that chart. The red line starts to go up. Looks like at the end of 2021. And Fed was way behind then. And they waited like, 4 or 5 months. And then finally they start catching up. And then they catch up to the 2-year at the beginning of 2023. And then the 2-year, probably with Silicon Valley Bank, they're like, whoa, we've gone too far. We're going to go back down. Fed continues to hike. Of course, they're off sides. The 2-year starts to go down right here. And then what happens, as you would expect, the Fed catches up. And now all of a sudden, it's just history is repeating when the 2-year Treasury is starting to go down. In fact, I don't think this is up. I don't know if this is real time, because I think the spread now is substantially more, because Fed funds, we know that's 4.33. Where is it saying the 2 years, Josh? There you go. Thank you. So, okay, so it's close. It's just a few basis points off. But you can see how this works, guys. And this is one reason why I want to really get hyper focused on the 2-year Treasury. And I would suggest you do the exact same thing, because if we see this red line really start to go down, because, well, before I get there, let's go over to the Census Bureau. George, come on. CME Group right here. This is the market probability on Fed rate cuts. This is not the next meeting. That was the one after. So this is March 19th meeting. So we'll call it a week or so. And right now we've got the odds of a pause at 96%. But check this out. Since this more recent market action, the odds obviously are changing significantly for May 7th meeting, where now they are 50-50. 50-50. And then we go out to June, and now all of a sudden we've got a 41% chance that, or excuse me, they're starting to price in a couple cuts here just before July. So things are really, really changing quickly. But my point here is that the market is still pricing in a 96% chance they pause. So if we get the 2-year really dropping over the next few days, it'll be really, I really want to pay attention, because I don't know if 96% is, I'm not saying that it's like 50-50. I'm not saying that at all, but it may be 80 and 20 based on what we're seeing in the 2-year Treasury. That's why we really need to watch that one like a hawk. But let's go back to other market action here, because I'm sure everyone is really wondering what happened to gold. Gold down, nowhere near as much as the other assets. What's really wild is copper is still up at 4.6. That seems to be an outlier to me for sure. But gold, we're down, 2,892. So gold hanging in there. I mean, really doing its job. Everything is down today. Almost everything is down. And gold is down a lot less. And that's why often in disinflation and sometimes even outright deflation, you do get gold does perform well relative to other assets, because it still goes down, but a lot of times it goes down a lot less. And unless you get a big liquidity event, and then that's when you see it really tank. But there again, all assets are tanking, and that's generally your opportunity to buy, which is what we saw during the cerveza sickness, also what we saw during the GFC. Now here's the big one, guys. Oil now down under 66. We've got a 65 handle on oil. And that's with a lot of production cuts. I know they eased off the production cuts for the supply side, but it's hard not to assume this is telling you a lot more about the demand side than the supply side of the equation. Now, I want to go back to gold because we actually have a sponsor for the first time on this station. And Keith Weiner, I just interviewed him for the RoboCapital's interview channel. Great guy. I didn't really understand his model too much until they came to me with this opportunity. And when they explained what they do in their business, I'm like, this is a no-brainer. So I actually set up my own account with Monetary Metals, and I wanted to just tell you guys about it. And what, in fact, here's the homepage. And I've got an account, but right now I'm in the process of putting my gold into a yielding account where they not just pay you a yield, but they actually pay you in gold. So let's say for a moment that you have 100 ounces, just to make the math easy, and they're paying a 4% yield for the gold annual. At the end of the year, you have 104 ounces of gold. It's not like you get the dollar equivalent of the 4%. You're not paid in dollars, you're paid in gold. So you get that price appreciation, assuming that that's what happens, with the actual interest rate as well. But the great thing here is another great thing is most of the time when you got quite a bit of gold, you've got that negative carry because you've got the storage fees. But here, instead of having to pay to store your gold, you are actually paid. And there's some counterparty risk. So you got to do your due diligence. But what I'm going to be doing, because they sponsored the channel for like 3 months, which is great. So it gives me a lot of time to explain to you guys how this works. So once I get the gold in a yielding account, I'm going to go ahead and sign in for you guys live. And I'll show you the dashboard and kind of, what I'm doing on the back end there. And it's such a great company. I think Keith is awesome. He's a straight shooter. He's one of the smartest guys in the gold space. And if you're someone that has some physical or silver, physical gold or silver, and you're interested in getting a yield that's actually paid in gold, I would strongly suggest checking this out. I mean, again, before we even did the sponsorship deal, I was like, this is a no-brainer, and I wanted to set up my own account. So you can check it out at monetary-metals.com. monetary-metals.com and use /Gammon. So Josh, please put that in the chat. Put that in the description, the pinned comment. Just one more time, guys. That's monetary-metals.com /Gammon, because then they know you heard it from me. So anyway, let's get back to the CNBC homepage here. I wanted to get back and finish my thoughts on oil. And we see nat gas 4.46. Oil prices fall 1% as tariff uncertainty keeps investors on edge. And again, I know they're trying to pin this on Trump, and I do think he's a large component of it, but I think there's just a lot more at play. It's kind of underneath the surface. But another thing that I was talking about with some of the guys here is potentially Trump's strategy to, I don't know if I'd say create a recession, but to, just let Elon Musk go to town, cut all of these jobs, which they know is going to decrease aggregate demand, as a way to kind of flush out the malinvestment, we'll call it. And you do it quick, you do it right now, and you can still blame Biden. And then what happens is that not only flushes out the malinvestment, but even if you get into an economic contraction, that definitely lowers rates. So you've got lower rates, but yet a steeper yield curve, assuming that the 10-year Treasury went down to, like, let's say 3.5, and you got the Fed funds at 2.5. So you've got 100 basis points of 100 basis point delta between the front end and the 10-year. So that helps banks out, the banks that are making money by borrowing short, lending long. So it kind of bails out the banks. It gets them more confident. This is at least a theory. It gets them more confident. Then once they got that malinvestment out of the system, they've reduced the size of the federal government, hopefully increasing the government spending as a percent of GDP, which would imply the private sector is producing or responsible for more of that economic output, which would make the economy far more efficient. And then you get all of the growth going into Trump's, let's just say, third and fourth year. I talked to a lot of guys about that today, and that's something that they're really mulling over. So maybe, just maybe, that's part of Trump's 4D chest, if you will. And so if that's the case, we should assume that there's a high probability that this could continue as far as this price action that we're seeing in the market. I think the big concern with the guys here is that this bleeds over into the housing market, because the way they see things is the US economy is highly, highly dependent on housing, probably more so than the stock market. So they're kind of, what they're seeing as far as downside risk right now is that what Trump does, if that's the plan, impacts housing prices. We create additional supply because people have to sell because their purchasing power is going down. You're going to recession, they're losing your job. And then that creates this feedback loop, which makes the economic data come in even softer than it otherwise would have been, which brings the stock market down even more, which is the other component of the average American's net worth, their 401k, which then reduces aggregate demand, which forces more people to sell the home. And then you have kind of that doom loop. That's, I'm not saying that's their base case or what they're saying is a high probable outcome, but it's definitely something the guys here are really mulling over. All right, and I think we'll kind of leave it there, Josh, unless you had anything else to talk about. I think that's the big news of the day. And I think the main takeaway for this video, guys, at least for me, is watch. Oh, I forgot to go over one thing, guys. Hold on. Forgot to go over one thing. The other thing that I'd like you guys to focus on, at least that's what I'm going to be doing, is the 90-day moving average of the near-term forward spread. We've talked about that in a few videos. And for me, you can't just look at one chart. You can't just look at one data point. You've got to look at everything and kind of aggregate it together and then come to a conclusion as to what the probabilities are based on your thorough analysis. But this is one thing that I definitely think that you should add to the mix. This is the 90-day moving average of the near-term forward spread. And you can see that out of all the yield curves, this one I think has the best accuracy as far as timing. So what I'm watching, I'm definitely hyper-focused on the unemployment rate and the 2-year Treasury yield to see if we start getting that big spread between Fed funds, which in my mind would increase the probability of the Fed cutting sooner than later. All right, guys, enjoy the rest of your afternoon. As always, make sure you are standing up for freedom, liberty, free market capitalism. See, no, the reflection's even worse. I was hoping I could give you guys a shot of the Caribbean. We'll see you on the next video.